Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
Now, there's two types of entries that you're going to see here, and in the Forex markets, and the reason why you really want to use options right is because in the Forex markets, 24-hour markets that move all day and all night, you may not be in front of the computer for this pullback entry. This is actually one of those buy the retracement type entries. You may find better success if you buy these breakouts. If you go back, and I'll show you when we get to the later part of the presentation, if you go back to last year, the dollar index, once it broke out of its stage one accumulation, it tacked on 10% with no retracements in just a flash. So you never really got the chance to buy the breakout. So there's two different types of traders. The trader who looks to buy dips and the trader who actually likes to be a part of the breakout. Okay? And it's the same thing here too when you're talking about shorting rallies into a resistance level or actually being a part of the breakdown from the resistance level in the first place. So you have the opportunity for one trade, both trades, or either trade. And a lot of people cannot find it in themselves to short rising prices. But remember, the professional is always going to be shorting rising prices. A market maker, his job is to take the other side of a trader's trade. So he's always buying when people want to sell and selling when people want to buy. So this gives you an edge in trading if you really start to think about it. And if you're using options here, if you're actually buying puts when prices are rising, it goes a long way towards avoiding that volatility crush. If you're doing some kind of a spread to where you're actually selling calls above this area, the calls are getting very expensive, the puts are getting cheap, kind of helps out with those spreads. Okay? But remember, in the Forex markets, you may not get retracements. So this is one market where you might want to think about learning to trade with both strategies. So these are the four different types of entries that I use myself. I buy breakouts above resistance, or I buy pullbacks to the origin of that breakout, which I call buying a dip. And if you're in an uptrend, you really want to be buying pullbacks. You want to be buying dips. Where people get in trouble is not correctly identifying if you're in an uptrend, a sideways trend, or a downtrend, and using the wrong strategy. So in other words, if the market's rising and you're constantly shorting rising prices, you are going to have problems. Okay? All right, selling a breakdown below support is another way to get into an entry, as we mentioned. Okay? So if prices are trading sideways in a channel after a big move up in price, maybe they're going to complete that entire cycle. If you miss the breakdown and you're in front of the computer at the time that it rallies back to the origin, that's an opportunity to short a rally. And this is what it looks like. In both cases, though, this is a key. In both cases, if you're going to buy a breakout above a resistance area and there's sellers just above you, that's probably going to be one of those 70% breakout trades that usually fail. You want to make sure the distance to the first area where there's some kind of resistance or a pocket of selling, a pocket of trading followed by some selling, that's probably where you're going to have a high probability trade here. As long as there's room between where you're entering and your first target. Okay? We like to tell our students, make sure you go for 3 to 1s as a general rule of thumb. 3 times the reward for the amount of risk that you're going to take every time you take a trade. We call it the profit margin. This is an example of somebody buying a breakout right into an area where prices have based and dropped in the past. Again, this kind of resistance here represents orders that probably need to be filled before price can rally higher. There's going to be many times where you're going to get into this area and you're going to break through and you're going to go on higher, no question. But if you're constantly making a career out of buying this into one of these resistance areas and wondering why your trades aren't working, it's really because you're not giving yourself a profit margin. Buying a pullback to a pivot low, again called buying a dip. So remember, we've got a stage 4 decline, a little accumulation, followed by a new uptrend. This can happen on a 5-minute chart, 2-minute chart, weekly chart, daily chart. If you see this pattern, especially after a big sell-off, this is possibly the beginning of the reversal into the new trend. And what's it going to cost you really to find out if you're low or if you're wrong? If you're placing your stop losses below the lows here, so that if price does want to make a new low, that's all you're risking. And every trade you take comes with risk. No matter what anybody else comes in here and tells you, or anybody tells you anywhere, every trade has risk. If these sellers are selling because something happened terrible in the world, you want that protection down here. Here in the ISE, using the FX options, that could be a put. And if this is a catastrophe, that could be a very good trade, or at least, if not a good trade, at least protect your capital. So here we have it again. We're going to either try to buy a pullback if we miss the actual breakout, or if we can, we're going to try to be a participant in the actual breakout here. A lot of ways to do this, of course. Just place an order to buy above the highest high of the consolidation area, maybe 5 pips above, or if you're using an option, believe me, the volatility is still pretty low at this point. You'll still be able to get that call option pretty low. Here we see prices actually on this particular chart. We based for a period of time after a sell-off. So we have the down, sideways, up pattern. And all of a sudden, during the course of this particular candle, prices actually came back down here to the origin of this move. So if you were not a part of this move, this is your second bite of the apple. And again, remember, it is a pullback for a low risk, high reward buy entry only if you're in front of the computer when it happens, or if you're planning for this kind of trade in advance. Remember, you'd like to be a part of this, but sometimes that doesn't happen. Here's a chance for you to have a second shot. All you're doing, again, if you do buy here, is placing a protective stop loss below some of these pivot lows to the left here. And the worst that could happen is the sellers are really aggressive and they want to take prices lower. And if that happens, that's a loser. But that's trading. So on this particular chart, we based after a big move up here for a period of time. We had support at the bottom of our channel. We had some resistance at the top. We couldn't make a new high. Eventually, the number of buyers drops to 0. They're the only reason that prices decline from this area. We still got plenty of sellers, but no buyers. And you short the actual breakdown here. And as you can see on this chart, if you see the opposite picture, a period of basing before a big rally, that's probably where you want to place your first target. And again, if you do enter it here when the breakdown happens, you want to place your stop loss above these highs just in case the market does want to go on and make a new high. Because every one of these trades, again, could just be a slight little retracement followed by a rally back in the primary trend direction. So here's what that looks like. We actually base up here at a period of time. Finally, we run out of buyers and we decline below this area. And just like this picture down here, that becomes a natural first target for this trade because the last time we traded at this price level, there were more buyers than sellers and prices rallied from here. So as long as I've got room, again, I could take both of these trades if I want, as long as I understand what my risk is, because if I'm wrong, preservation of capital in trading is how you stay in the game. And the longer you stay in the game is how you make money. Okay? The last entry here is shorting a rally into a pivot high resistance. Prices traded here sideways for a period of time. Couldn't go higher, couldn't make new highs. Finally, a candle closes below this area. Right away, I see this picture, and I say to myself, this is a low-risk opportunity to see if we're going to have the reversal. That's the key. If this happens after a big move up, after a big long trend move, this is more likely to be the reversal. Okay? And the cost to find out is to simply buy the put here with protection above here. I'll just close the trade if it doesn't work out while I can. Obviously, if the next candle wants to rally through and make a new high, they want to take prices higher.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.